It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And sitting in, the man himself, Michael Becker.
Hey, Paul.
You know who Michael Becker is. He's the guy who's raised over $150 million in equity to go out and purchase how many units, Michael?
We've done about 6,700 units so far and over 33 properties.
33 properties. Michael has gone from being a loaner of money to an owner of real estate. And so, we're almost into a new year. We're getting into a new year, new tax year. How many K1s are you going to issue this year?
We're in the middle of trying to get nearly 900 of them prepared and sent out by February 28th is our internal deadline. So we're busy in tax hell, so it's good times.
Michael and his group over at SBI have done a wonderful job, and we always like to have Michael in the podcast for Ask Mike Mondays. But who else is in the podcast? It's the professor himself, James Eng. James, how are you?
Great. Thanks a lot, Paul, for having me.
So James stopped in, so we appreciate James being in the podcast. Listener of the podcast writes, Michael, have you adjusted the IRR lower in deals you are doing to account for lower cap rates / higher interest rates and lower rent bumps? How are your investors responding to more challenging, competitive / higher valuations ?
Yeah, I think for sure it's become a little bit more challenging, to operate today than what it was 2 or 3 years ago from the standpoint that cap rates have compressed quite a bit. And then, the rates generally are pretty comparable to what they were a couple years ago, but the cap rates have compressed, and then then the rates go up and down a little bit. So the positive arbitrage isn't quite there, and from your cap rate over your interest rate, and then as a result, your leverage is getting cut back as these loans are getting debt service constrained. So not only are you not have the arbitrage, you're having more equity, so returns are naturally kind of coming in a little bit. So what we've kind of been seeing for the most part, the last several deals we've done, have kind of what I like to say, what does it take to track capital? You got to produce somewhere between a 14 to 16 IRR with the base of people that we have today. That's really two kind of components. So part of that is the yield along the way, and part of that's the capital gain at the end. So talking about the yield along the way, the holy grail that we've always tried to achieve was a double-digit cash-on-cash yield on stabilization, and that's becoming harder to do today, obviously, than a few years ago, just because of what we just talked about. So kind of what I've been saying here lately is last year's 10 is this year's 9. So, what used to be 10 is, 9 or 8.5 maybe. So really that's kind of, that's stabilization. So think of that like year 3. So year 1's kind of like 5, maybe 6. Year 2 is kind of 6 or 7, and then 8.5, 9, kind of year 3. And then the other component of it is kind of what we'd call like an equity multiple, Paul. So like if you give me $1, I'm trying to give you between the cash flow along the way and the capital gain at the end over, say, like a 5-year period. If you give me $1, I'm trying to give you $1.75 or $1.80 back over that 5-year period between the cash flow and the capital gain. So if you average all that together, you're 15%. Something like that, right? That is getting money just thrown at us today. And a few years ago, we were thinking we'd do 22, 25, and we ended up doing 60. That's kind of what happened in the past, but that is not in the marketplace today. So it's just a big world of money out there. And if they don't put it in this, they got to put it in something else. So you stick it in your checking account and earn, 1% if you're lucky, 2%, and then you get eroded by inflation, or you put it in the stock market. And as we record it, there's been a little bit of turmoil at the end of 2018 in the stock market, so people getting, crushed there. Or if you buy a bond or rates go up, you're going to get crushed. And so there's just a world of bad options out there. So 15% in something that produces a current yield that has, a real asset behind it that's indexed to inflation, that has long-term fixed rate debt, professionally managed in a city that is growing like crazy from a population and job growth perspective, that seems to be, that makes sense to me. It seems to make sense to other people. So James, what do you have a lot of clients. What are you kind of seeing from return?
I think there's a couple of things that are impacting, with these lower cap rates. Some investors just are stepping away a little bit in terms of, so the demand for deals is decreasing. And so a lot of these whisper prices that we're seeing, people aren't able to hit. And so whereas if you didn't even put in your first offer at the whisper price, you didn't get a call back. But now brokers are calling us and saying, hey, can we get this guy to tour? Can we get this? We're just trying to get to the whisper by the best and final price. And so that's helping investors. And then also another thing that we're seeing is that if you are able to hit to sort of that 15% IRR, there's plenty of money there because the relative return that we're talking about compared to everything else is still there. And so people still like multifamily, people still like Dallas, people still like Texas, the areas that have the population growth, have the employment growth. People are still bullish, and they're just having to take a little bit longer. It's not going to be a 2 to 3 year 100% return on your money. It's going to be a 5 to 7 year now. And so as long as you're taking a longer term approach, people are still able to raise money. I would say it's probably still a little bit harder probably for that first or second time guy. The guys, I think right now where people are seeing if there is a recession, they really want to see somebody with a track record and that have been able to turn a couple of these deals first before they put their capital with them.
You know, I think it's a little bit of a mental game. A lot of these older syndicators remember when the properties were selling 10 years ago at $25,000 or $30,000 a door, and now they're selling for what these days, Michael?
80, 90, same property. It would have been 30s, probably 90, especially in the workforce housing.
Yeah.
From 10, the recession, it's definitely more than doubled, if not almost tripled in price. Now, I would challenge you to try to find a single one bedroom unit that is not in the hood in Dallas Fort Worth for less than $800. Where if you go back 10 years ago, that was like you could do that for $450 or $400, and
Right.
rents have doubled. So what's changed is the cap rates went from 8.5 to 5.5. Right, that's kind of that makes up the difference between doubling the rents, but tripling the prices. The cap rates have come in, and that's kind of really made up the difference.
But I see a lot of people wanting to buy a hard asset. I mean, the stock market for last quarter, going into the end of 2018, going to the first week or two of 2019, we've seen 10, 15% decline.
Go to 20, I think.
Yeah, 20% decline this year in 2018. So people still want to really own or control a hard asset. And so, going back to the analogy that everybody has ideas that units worth $35,000 or $40,000. But I think today really people are looking for cash flow. And they want to have something that's going to give them cash flow over a period of time. I mean, I know we all try to buy these value-added properties, buying them at X, fixing them up, selling them at Y, and trying to earn a double-digit rate of return. But I think a lot of people, whether they're 50, 60, 70 years old, are just looking for cash flow on their money. So that they don't have to double up on these deals. But what's the alternative to put their money into to get a 6-7% rate of return on their cash? And
It's not good. You're in a junk bond, and then there's a whole lot of risk with that.
no, and you're buying a hard asset in the middle of the country. You're buying a durable property that people need to sleep someplace. They need to live their life someplace, and these workforce housing properties are the ones that provide the cash flow. Not probably the brand new Class A buildings, but the properties that are B and C properties that offer you the cash flow. So it's something that your parents would put their money into. I'm not talking about everything of their retirement, but put a portion in that actually gives them a cash flow so they can go to the Walgreens and pay for something because of cash flow. James, anything else to add?
My one piece, and I'm trying to tell general partners this, is before almost every deal closed in 45 to 60 days, because as soon as you put out an email that we're going to raise money for this project, the money came in like the next week or 2 weeks.
Right.
And that is not the case anymore. So if you are going to go under contract on a deal, put in a couple built-in extensions at your option, because capital raising is taking longer than most people think right now.
Yeah. Anything else, Michael?
Especially if you're a first or second timer. I mean, experience matters, track records matters, and get that list as big as you can, because you never know when the stock market is creating. Maybe some of these guys are scattering because they're nervous because they lost 20% in their 401k and they don't want to, put anything that's just going to cash. So, make sure that you over raise, you get kind of over committed verbally. I think that's just generally good advice, but it's even more important today than I think a year ago. But with all that said, I'm still pretty bullish on Texas multifamily. I think it's going to be, good for a very, very long time. And that's why we're tripling down on everything we have. And, I think if you get similar environments like what we have in Texas, maybe like in Phoenix or Atlanta or Orlando or some of these, sunshine states that have favorable tax advantages, population growth, job growth, those are, going to be good markets in the long run.
And not having extreme high leverage. I mean, there's something to talk about being conservative. Last 4 or 5 deals, Michael, what has been your leverage in your transactions?
I mean, so we've been doing some more loan assumptions, so even some lower. We did one at 55 levered, but
So 50 so you brought in 45%.
But generally speaking, we're putting about a third down. About 2/3 debt, 1/3 equity, plus minus a couple points either way. That's generally kind of what it is. You're not seeing too many of these deals, even in the James was the last kind of workforce housing deal. And these deals are getting debt service constrained at 72, 71,
just depending on the deal.
74. So, I mean, you're not getting to 80 anymore. When was the last time you guys did an 80 on a Fannie Mae loan? Long time, right?
Less, 6 months, 7 months.
Yeah. And so that's kind of like the unicorn. So just be prepared. Lenders are being prudent. So whatever the next contraction is going to be, it's not going to be a lender-driven event like the last one was. It'll be definitely different, whatever sparks the fire, because the lenders have held their underwriting criteria, and I think these loans are pretty prudent. So I'm not foreseeing any massive disruption within, the real estate space, in particular due to the lender. Now, I mean, who knows what's going to cause it? Obviously, it might be a global slowdown that then hits the U.S. and then hits whatever market you're in. But all markets aren't created equal, so make sure if you're in a high flying market, hopefully you've hunkered down, got some good debt, because trees don't grow the sky, so stuff will change at some point. But if you guys follow the fundamentals, I think everything will work out in the long run.
If somebody wanted to get some more information about what you do, Michael, tell us a little bit again what you do, what strategic property investing does.
Yeah, really the primary focus of what we do is raise capital and buy good quality, large scale multifamily projects. So in Dallas, Fort Worth, and Austin. So that's kind of what we focus on. So just simply go to our company's website, which is www.spiadvisory.com. That's SPI like spy advisory.com. Fill out a contact us form there, and I'm always happy to have a 10 or 15-minute telephone call with listeners of the podcast, and maybe potentially working with us either to invest alongside us in some deals, or one of the things that we do as well, if you have a little pot of money and you're looking to do your own deal, we do what we call like advisory services. So we'll help some clients. Typically the minimum is about $2.5 or $3 million in equity. But if you have like a 1031 and you want to come into one of the Texas markets, and you don't know anybody, we can help with providing some credibility, leverage our relationships, our execution, help you get a team built out, et cetera. So if you guys have, that $2.5, $3 million or more, like in a 1031, that's usually a pretty good target. Feel free to reach out as well. We'll try to help you guys get set up in Texas.
Yeah, that's the best type of leverage you can get out there is professional leverage coming from SPI. So we think the world of Michael and his team over there. Thanks for coming in, James Eng, the professor himself.
Special episode here.
That's right. All right, Michael Becker. I'm Paul Peebles. Have a great day.